Good morning again. My name is Damola Owolada. I am the manager of the SADC Financial Inclusion Program at Finmark Trust. This presentation will focus on the topic of digital payments and its role in financial inclusion. In terms of the overview of the presentation, I will be discussing digital financial services as an overarching category of which digital payments is a component of. Then I will be talking about the drivers of digital financial services, obviously with implications for digital payment. And I will then look at some of the ways in which we can map and measure digital financial services and its implication for financial inclusion. So, what are digital financial services? Digital financial services include a broad range of financial services accessed and delivered through digital channels, including payments, credit, savings, remittances, and insurance. Digital channels include mobile phones, point of sale devices, ATMs, and a computer. One needs to also consider the importance of a digital store of value. That is a platform in which a customer can actually digitize their cash. So a digital store of value could be a bank account or mobile money wallet, which is the essential basis or the launchpad which digital payments can leverage on. Without a digital store of value, it would be difficult, or it would be a challenge to make a digital payment. So essentially, a digital store of value is mostly required to engage in digital financial services such as digital payments. So some of the drivers of digital financial services are discussed in the next slide. Why digital, or why do we want to digitize financial services, including payments? The very first one there is to reduce the cost of access and usage to financial services. So if we think about the cash handling fees and the investment in agent and branch networks, a digitized payments becomes quite important in reducing the cost of using payment services. Digitized payments has the advantage in a sense that it increases the speed of the services. One would also find that there's an increase in the convenience of the payment service itself. Digital payments allows users, both persons and businesses, to have a payment history, which could then be used in credit risk assessments for those who might want to access credit services. Digital payments can also provide high resolution information on demand for money demand, which then improves monetary policy implementation. Another aspect of digital financial services or digital payments is the fact that it formalizes, in principle, the cash and informal economy. So the moment users have digitized their payments, or they're using non-cash methods for transactions, be it person to person or business to business, we are in fact seeing a formalization of these transactions, being that they're now outside of the cash economy and they're moving into the formal payment system. This slide talks to some of the key requirements that one should consider in order to optimize digital financial services, including digital payments services. One of the important ones here is the need to have a multilateral, interoperable national payment system between banks and non-bank service providers. What we found is that the existence of a national switch typically enables this. So it's quite important to have a multilateral interoperable system in order to increase the value proposition of digital payments. It would be important to ensure that people who have mobile money are able to pay people with bank accounts, or people with bank accounts are able to pay people with mobile money, for instance. What is also quite important for digital payments or digital financial services is the existence of telecommunications infrastructure, electricity infrastructure, access to mobile phones, access to financial access points where the digitization of cash can take place. For instance, ATMs, agents, branch networks, etc., serve the purpose of taking cash and then providing the user or customer with a digital wallet or account in which they can then make payments from. Another aspect that's quite important is the availability of USSD-based services, particularly for customers in Africa with 2G phones, second-generation mobile phones. And there are quite a number of Africans that still have the old second-generation phones. And for them to be able to engage in digital financial services outside of the apps, mobile banking apps, etc., it would be required for them to have a USSD based service. Literacy levels is quite important in terms of optimizing digital payments as well. And consumer protection legislation is also quite important, especially to engender trust in digital payments. The research shows that quite a number of people, particularly people in rural areas, still prefer face-to-face interaction. And obviously this speaks to the trust issue, and consumer protection legislation and the enforcement and implementation of it would then serve the purpose of increasing trust, which could then lead to the optimization of the use of digital payment services. So the next set of slides will look at how we map or measure digital financial services and digital payments with respect to how that is reflected from a financial inclusion perspective. So we'll start off with this little grid here, looking at 3 market agents, persons, businesses, and government, and their interaction with each other. So if we look at persons and to person transactions or payments, that would be remittances. If we look at persons to business transactions, that would be merchant payments, the purchase of goods from a merchant. If we look at persons to government transactions, that usually manifests itself in terms of tax. So if we then go to businesses and look at the business to person transactions, we'll be looking at businesses paying persons salaries. If we look at business to business transactions, we'll be looking at supply value chain activities, and business to government instantiating tax. And when we then look at government to persons, that could be a reflection of social protection payments, welfare payments. If we think about COVID, in the last 2 years, there were quite a few COVID relief funds, which were essentially government to person payments, and that would essentially be that transactional relationship in terms of how we see it in reality. And then government to business interactions could manifest themselves in government loans to businesses or government grants to businesses. And then government to government transactions could be essentially the process of which fiscal allocation payments are made from, say, the Treasury Department to the Ministry of Agriculture or Ministry of Works, etc. I've put this grid here today to point at some of the interactions that are most likely to drive financial inclusion. So what we've seen in the data is that the person-to-person remittances has been a key driver of digital payments. We've seen a nascent change in person-to-business transactions in terms of merchant payments, which has been enabled specifically by mobile money. Financial inclusion is mostly driven by mobile money in the SADC region because the number of adults with mobile money accounts compared to bank accounts is much more higher. So mobile money has essentially been the basis of which merchant payments is happening. Although card payments using POS devices has also taken shape. However, when we look at data comparing card payments using POS devices compared to person-to-business transactions using mobile money, we've seen that the mobile money platforms typically tend to be higher than the card-based. And I've highlighted the cells in yellow to show the interactions that are most likely to lead to financial inclusion. So from a policy perspective, if one can target remittances, merchant payments, supply value chain activities, the payment of salaries, and government to person transactions, these transactional relationships and payments could drive financial inclusion. So this slide here basically aims to provide a framework of how individuals interact with financial services and obviously payment itself. So as an individual who has labor to sell, either as a farmer or you're an informal sector, earning your living in the informal sector, you're self-employed or you're a dependent or you're salaried, in terms of your livelihoods, when you get an inflow of funds, which could either come as a regular income or part of your savings or credit or trade or social assistance, it will go through a channel which could either be face-to-face or non-face-to-face, which could be ATM, phone, personal computer, bank branch agents, and the medium could either be cash or digital financial services. And obviously, when as an individual you want to now make an outflow, going back to the previous slide, the same framework still applies in terms of institutions of which you can deal with, the channels which you can deal with, and the medium that you can use. So this slide essentially looks at contextualizing the needs that customers have. Either this need is a resilience need, that is to anticipate unexpected events, or it's to plan for future goals, or to be able to ensure liquidity in terms of cash management. This framework just embeds the financial needs that an individual or a business would have, and obviously has implications for financial inclusion, and also implications for the use of digital payments services. So this slide here is essentially an example of how one could potentially track financial inclusion from the basis of the value chain of digital payments or digital financial services. So the far left flow chart, if we start from the bottom, we can see the main source of income being cash, and that could then bifurcate or break down into two separate outcomes. You could either be able to access that income through a bank account or mobile wallet, and obviously if you don't have those platforms, it means you are basically existing in the cash economy. For those with a bank account or mobile money wallet that have put their cash or their source of income in those platforms, the bank account or the mobile money wallet, one can assess whether or not they've used their account, whether or not that account is dormant or active, which is why we have the account used in the past 90 days there. And then finally, we can also then track whether that account is being used as a post box. That is, one receives money and then takes the money out, or one keeps a digital balance and then actually make digital payments. So what I'm showing here is an example of the value chain of digital payment services, which one can track using a demand side survey. I'm using this example to essentially provide the basis of which a demand side survey can help generate or map the role of digital payments in driving financial inclusion. The second flow chart there essentially goes a step further, in the sense that the money is paid into a wallet or bank account, and you can also see that the same kind of interactions are happening for those who have active accounts versus those who are dormant, and then looking at those with the active accounts to try and understand whether or not they're engaged in digital payments. This slide here also looks at mapping digital payments, again, in terms of a demand side survey perspective, in terms of what one can do in terms of mapping digital payments to then reflect the level of financial inclusion. So what we have here is the income source, which is in the first column on the left, and then tracking the number of adults that receive income from those income sources. We also could look at the percentage of adults who receive income from those sources as their main source of income. Then we could look at the frequency of receiving the main income, which could be weekly, monthly, fortnightly, quarterly, occasionally, etc. And then from a digital payments perspective, what we will then be able to do is to track those that receive their income in cash versus those whose income is paid into a bank account versus those whose income is paid into mobile money services. For the outflows, we can do something similar. So we can look at the very first column there, showing the types of expenses, the types of consumption patterns that a typical person would have. So you can look at payments for goods and services, transport, social activities, airtime, medical expenses, education, utility bills, etc. And then you can then track, using a demand-side survey, those that are using either cash, check, over-the-counter bank transfers, prepaid cards, ATM, credit card, internet banking, mobile banking, and mobile money. From a supply-side perspective, so for institutions or maybe the regulatory institutions that have data on the national payment system. So if we think about the national payment system in Angola, for instance, one should be able to use that platform to generate this type of dashboard, which would then show the level of which digital payments is driving financial inclusion. So again, this is an example of a typical dashboard that can show that, where we can look at the total customers that have used USSD, for instance, or bank teller, or mobile phone, or internet banking, or ATMs, etc. We can look at the number of transactions across these platforms, which obviously some are digitized and some aren't. We can look at the values, and we can look at the average transaction sizes as well. So I'm using this example, which is drawn from some of our work in other countries, but the spirit of presenting this is to show ways in which one can use demand side data or supply side data to map financial inclusion, which has been driven by digital payments or digital financial services. This is my last slide. Thank you very much.